Good morning, ladies and gentlemen, and welcome to SRP Americas 2021 to this keynote presentation. Buenos días a todos y bienvenidos a la conferencia SRP Americas 2021. My name is Agata Skrzypczak, and on behalf of SRP, I wanted to thank you all for joining us today for this conference. Muchísimas gracias por estar aquí con nosotros. With me today, I have Rick Redding, the CEO of Index Industry Association. Rick will give us a presentation, and some of the topics he will discuss today include assessing the state of the index and benchmark industry, the emergence and evolution of ESG, as well as potential global issues impacting
Good morning,
businesses.
ladies and gentlemen, and welcome.
Please
to
note
SRP
that
Americas.
Rick is happy to address any questions from the audience,
Yes,
which can be asked using the chat box on the right bottom of
My
your
name
screen.
is Agata Skrzypczak.
Now I will hand over to Rick.
I wanted to
Agata, thank you for the introduction, and I just want to thank everyone for attending either this morning or this afternoon, depending where you're looking from. And I was just saying that I was so looking forward to seeing everyone in Chicago, because there's something about being in person and having a coffee or having a drink and really talking to one another and getting to know one another. And I missed that, and hopefully next year that will take place. But if I may, to start off this morning for the conference, trying to do the first talk is always a challenge, because you either have to come up with something very controversial or you need to set up the agenda. And I've chosen the latter because I think there's a lot going on underneath your industry that you need to pay attention to, and something that I hope to give you a little background on what may be driving your business, and also maybe challenges to your business going forward. Next slide, please. Next slide, Agata. Thank you. So as Agata said, I'm not going to go through that long, daunting agenda for this talk, but kind of three areas I want to talk about. First of all, I want to talk about what's going on underneath the industry that you work in, what's going on in the index industry, and what some of the trends are that you may not be seeing yet on the product development side that I'd like to highlight. I would like to talk a few minutes about ESG in particular, because of its tremendous growth. And then I'd like to end it on regulatory issues that may challenge your business going forward. It's something normally I would never talk about, but I think the risks are so important for you to manage and to look at that I thought it warranted some time, because we're in an era where global regulation may impact your business, and it may be coming from a regulator across the globe, which has not typically been the way how our businesses have operated. So with that, let me jump into what II is, if you're not familiar in what we do. II is a global industry association of kind of the leading and largest index providers in the space. All of our members must be independent index providers, and I'll explain that in a minute. Roughly, our membership is about 1/3 in Asia, about half in North America, and the remainder in Europe. So pretty broad diversification. What we do is we do a lot on education. We do lots of survey work. We do white papers. We work with regulators, and A lot of what our focus has been over the last couple of years has been actually on the regulatory scene, even though it's not why we were set up. So next slide, please. So most of you are going to be either in the asset manager or product provider or data provider or market price maker. I know this is a simplified version of the ecosystem, but I think it's important for us to take a step back and say, what's going to be important going forward? I mean, if you look back over the last probably 3 or 4 decades, you've seen a lot of regulation in the exchange space. You've seen a lot of regulation on your side, on the product issuer side. More and more, you're seeing it on the data provider side. But what's really important here is, what is it that people do and add value? As I said, IA is only involved in index provision. That's why they're all independent. So none of our members are able to create product, nor do they make prices for the underlying securities on the indexes or benchmarks they provide. The benchmark industry really has grown from its kind of early days back in the kind of theoretical days when indexing came up in the 60s and 70s. Next slide, please. So our members do a survey. We do a survey every year, and our members administer a little more than 3 million indexes globally, which is quite a number, and hard to put your hands around that sometimes, because even though we're in the industry, we're hard pressed to name a lot. But it does tell you the amount of benchmarks there are in the world, and a lot of custom benchmarks, as opposed to investable product, a lot of the product that you actually, the indexes you use for your products. So we do this annual survey, and last year we saw something we'd never seen before, and there was a 40% increase in ESG indexes and benchmarks. To put this in perspective, most categories increase by 3, 4, 5% a year. And so this is a pretty fundamental shift in what we're seeing, what's being demanded by investors. And we'll talk about ESG specifically in a moment. But what we also saw was this increased movement towards fixed income indexing, which obviously has been behind the equity world, but kind of over the last 2 years, it's increased about 15%. And what we're also starting to see is ESG moving into the fixed income space, even though it lags quite significantly. So next slide, please. So why is any of this research and these surveys important to product providers? It really is interesting, because in doing this for a few years, what I've seen is there is a lag in between the kind of research and development and creation of benchmarks and indexes and the products that actually get put out into the field, the ones that you use. So what we've seen is a pretty decent movement over the last couple of years in the fixed income space, where these are last year's results. We do the survey in October, so hopefully by the end of next month, we'll have updated figures. But if you looked at this even probably 3 years ago, you would see that the United States had a big lead in the number of fixed income indexes. And I think there was some reasons for that. I mean, there was just a lot more securitization typically in the US. You had municipal bonds in the US that you don't have in Europe and in some parts of the world. But what we've seen over the last couple of years is, the European segment has really almost caught up now to the Americas, which I think is really important. And I think some of that has been driven by 2 things. One is obviously debt issuance, but it's also the use of more income indexes into products, the products that you guys create. nothing really all that exciting or surprising in the segmentation. I mean, obviously the big areas are kind of high yield and corporate and sovereign. So no big surprise there. But you know, what you do see is on this is a very small sliver of factor thematic ESG, and we'll see how that. Next slide, please. And let me contrast that to what happens in the equity space. So the have more of the index, the fixed income, but it's actually not true in the equity space. In fact, the United States is kind of third in that, and it includes North America in general, but they're kind of third in that. But when you think about it, it does make sense. I mean, they get written about quite a bit in the press, but it makes sense because of just the number of countries in Europe and in Asia Pacific as well. So not too surprising there once you think about what really drives that. The one thing that is interesting, and I think that should be noted here, is it's the global indexes that actually are the ones that are most prevalent. And the only reason I raise that is when we get into the ESG discussion, I think that has huge ramifications for your business in the next probably 3 to 5 years. Again, some people are surprised by the segmentation of the market. But when you think about it, depending on what country you're in, there's kind of 11, 12 different sectors. So sector indices are actually by far the largest component. With that said, it has come down just a bit. It used to be over 50% probably 5 years ago, but people don't think about how big of an area that is. Again, think about from an investor versus benchmarking standpoint is, as I mentioned, there's about 3 million benchmarks our members administer, and there's only roughly 9,000 ETFs out there. So you can clearly see that benchmarking is the #1 area of indexing. So next slide, please. So from our survey last year, we saw that 40% increase, and we decided to do a survey on how we were doing and how we were servicing the asset management community on ESG. I mean, if you look at this chart, as I think from Morningstar shows kind of the flow of funds over the last 3 years. It's still dominated by Europe in the flow. What we see is, though, the U.S. starting to do better in the last year or so. So it's interesting to see. And when we talk about some of the impediments on ESG, I think it's pretty clear. Next slide, please. So we did a survey of 300 asset managers across the U.S., the U.K., France, and Germany, all size, all types of management of products. Even looking down to the crypto world, just to make sure that we had a good representative sample of the asset management community and what really the thoughts were there. Next slide, please. So what did we find? Bottom line, what drives it is customer demand. I mean, that's the one thing I think that regulators have confused in parts of Europe, and in part is that if you create an index, it doesn't mean anyone will invest in it. At the end of the day, it all gets down to investor demand. And I mean, that was the key driver that they highlighted in what was driving their business. Followed by desired increase for return. The one kind of wild card in this was something that I got a third of the responses was reputation or regulatory risk. And after some of the highlights in the marketplace over the last few weeks, I think that's even a bigger issue for people. So next slide, please. So what are some of the major challenges, and what do we see as index providers as well? This lines up exactly with what we were hearing, which is a good thing from it. But a lot of the challenges we see around ESG are really about the access to data, the quality of data, transparency of the data. What really jumps out of the survey is that the corporate level disclosure not only needs more quantitative pieces to it, but it also needs just to be more consistent. Secondarily, looking at things around the standards in place. I mean, it seems like more and more people are coalescing around IFRS or TCFD, but there's one survey I saw said there's 100 standards out there. So I think as the standards become more standardized, people coalesce around them. I think the quality of what people will be looking is going to be better, but there are areas that do concern us, especially around the S piece of ESG, and that there seems to be some national, regional, cultural differences in S, which may lead to some problems, which I'll talk about in a minute. Next slide, please. So what we've seen is, as I said, a third of the asset managers said that this was a problem, and over half of them said that keeping up with regulation was going to be difficult for them in ESG. And that is what the Europeans have taken the lead in the regulatory world on ESG, and specifically have tried to create a taxonomy around getting people to agree what we're even talking about and having the same. They've created environmental taxonomies. They've just put out for a pre-consultation of sustainable taxonomy. But as easy as it sounds on paper and as good as it sounds on paper, it's really proving to be a difficult thing in practice to be able to really define what everyone's talking about and everyone's on the same page. I mean, let's just take the example of the French and the Germans are not on the same page, for example, on new. So next slide, please. So the Europeans have taken a first step, and they're the only ones that have done this. So they're a little bit out there on their own, but they've created two types of benchmarks in the climate space. One is a transitional benchmark, and the second is a Paris-aligned benchmark. And that is, if you're an asset manager and you hold yourself to provide one of these benchmarks, there are things that you need to follow and restrictions that you need to follow. Also, if you are a product provider and you're an asset manager, you are trying to put product into Europe, you also have to follow some regulation called the Sustainable Finance Directive. And that basically shows that there's 50 different metrics that you need to follow. The good news is with some regulation, they put all that out there and then realize the metrics don't exist for a lot of it. So they've scaled that back and they've pushed the implementation back. But if you are going to put product into Europe, you will have to follow the SFDR as well. Next slide, please. So after Brexit, we have to think about also what is the UK going to do. They don't have the same level of plans out there. There are some things that they are, pushing over on the benchmark regulation from the EU. But the UK has come out and somewhat embraced TCFD. They have put a consultation out there on greenwashing. They have done some issuance of sovereign green bonds. As time goes on, though, there may be some drift from the EU benchmark regulation. They have not put out their sustainable finance directives yet, but we expect there'll be some drift from that as well. And earlier when I said, the number of global indexes are important for all of you to think about, and that is, how do you do ESG if you don't have global benchmarks or global indexes to compare them to? Because one of the things we're concerned about is we wake up in 5 years, there's different taxonomies all across the globe. We know, parts of Asia Pacific are working on theirs. The US is working on something down that path. And the question becomes, how do you end up with global benchmarks if all the taxonomies are different? Or more importantly, will you have to provide different products into different markets based on different indexes? So something to think about as you move forward in your ideas on putting product out around the ESG space. Next slide, please. And this is the slide that I think people should think about. And what we've seen is the SEC has put out the unified regulatory agenda. And there's plus more things that I think they're going to work at. But I mean, it kind of looks like, I call them the 4 C's, that are something that are clearly this administration's priorities. I call it climate, cyber, crypto, and human capital. So it looks like the direction of travel and what has been publicly said so far is this will more be in the area of disclosure than in other types of regulation, but it's still early days. The SEC hopes by the end of the year to have something on climate out there for all of us to look at. But again, the SEC is also very, very, very busy. You think about some of the big things that they are tackling, and Congress is seemingly involved in this as well, is market structure. Payment for order flow will probably, get its first look in decades. I think the whole gamification / Reddit, Robin Hood situation is also being looked at. The question is, can people get on a social board and talk about securities? It's a pretty big issue and going forward. Also, recently we've just heard that they're also looking at the market structure around fixed income trading and encouraging even more exchange or transactional based way to incentivize that to happen in the fixed income market. So be aware of that. And where this group really needs to be aware of, they are looking at complex products for retail investors. So they're looking at annuities, they're looking at any structured products, they're looking at anything that's embedded in one type of wrapper or another. So something for all of your groups to think about, because this is the area that I think will impact or potentially could impact your business the most. And as I land the plane and turn it over to questions, in landing the plane, and the reason why I'm emphasizing regulatory in this talk, which, like I say, I never think about those kind of issues, is in my career, I mean, I've seen the 87 crash, the kind of UAL crash in 89 that led to, several of the buyouts, going bust and having issues in the 90s. I mean, if you think about the telecom crisis in 2000, 2001, and with the tech stocks, and then you think about the Great Recession in 2008 and COVID last year, kind of the one thing that pops out of any of these is regulation. I mean, whether it was Dodd-Frank in some of the earlier ones, whether it was, new capital requirements, new selling requirements out of the Great Recession. And I don't think we know yet how COVID really is going to impact all the regulatory agenda. I mean, clearly the move to ESG accelerated, in the COVID crisis. So I would just, pay attention to what is happening. In more and more, you're starting to see regulation be extraterritoriality, have extraterritoriality features to it. So even though the EU has passed benchmark regulation, it impacts all of you if you sell product into Europe. So you're starting to see this global regulation hit starting to happen in bits and pieces, and just wanted to put that in perspective for people. So with that, let me turn it over to questions and see what you're interested in, and see if I can give you my opinion on it. Any other questions? The first question is on self and direct indexing, and what is the association's view on the growing part of the market? I think there's two different pieces there. Self-indexing is, what, obviously, just to level set the definition, is what the asset management and bank community does, where they may create their own indexes for tradable products. It's not clear that it's that much bigger today than it was a few years ago, because if you think about it, most of the European banks have gotten out of the index creation business. Where you see self-indexing is more from the asset management community, and a lot of that's been driven to do that for the ETF market. So there's nothing wrong with self-indexing. I mean, I think as an investor, they should ask questions about potential conflicts of interest. I think there's some academic papers out there now saying, are there conflicts between the board? If you self-index, is there a separate board for the index provider and the asset manager? So it really is about really understanding what those conflicts are, and is that acceptable? I mean, and the reason why I say I think you may see it more on the retail side than you do on the institutional side, because kind of post Great Recession, many of the institutional participants want to see someone independent doing the administration of the index, even if it is. And what we've seen is that kind of hybrid model becoming a lot more common, in that the intellectual property may still be owned by the asset manager, but the administration's done by a third party, which is what a lot of the institutional investors are requiring. So that's kind of my thoughts on self-indexing. Direct indexing is interesting, and that you've seen a lot of the large asset managers buying some of the boutique shops, some of the fintech shops working in the direct indexing space. It's interesting to see what will happen as that moves forward. And the question is where will the money flow into direct indexing from? I mean, in talking to a lot of large financial advisors, what they've seen in the direct indexing space is a fairly large movement from the just SMA accounts that are looking at it purely for some of the tax benefits. And I think that will continue, and especially as the asset managers integrate some of the fintech companies, I think that will just get bigger and bigger. Hope that helped. If it didn't, please shoot another question back. Next question we have is about the complexity of indexes. And does that complexity necessarily translate into better returns? Great question. I think the right way to answer it is look at the asset flows. I mean, if you still look at some of the asset flows are still dominated into kind of the big, large market cap based indexes. I think you have to be very specific about the complexity. I mean, I go back in the quantitative days in my background in the 90s, where a lot of quantitative investing came and then didn't necessarily do so well. I do think products can become overly complex is from a marketing standpoint. They want to show that there's something different about the product, but you really, at the end of the day, you have to look at the methodology that people are following. I mean, one of the things IA is a big proponent of is having investors look at the methodologies of the underlying benchmark or the underlying index, because that will tell you a lot about how it will perform in different market conditions. I think, it's almost like active management in other places. I think some of the complexities have worked with managers that have some skill. In other places, it's not worked well at all. So hard to give a single answer, but I think really understanding the intuition of the methodology and why it's created that way really goes a long way into doing it. I mean, one of the things that I also talk to investors quite a bit about is, if the product's overly complex, can you replicate it by, breaking it into components and doing it much more efficiently? So two ways to look at it, but there's a large customer base of your customers that want to see it all in one product, and just for simplicity's sake for them. There's a question that is talking about that indexes are used to improve the optics of products. Is there a danger of misleading investors by focusing on the headline rate? Again, I think this is an area where you've seen the regulators look at of saying, are people comparing apples to apples? I mean, with 3 million benchmarks out there, you would think that there's maybe a benchmark better than maybe better than what they're using. But again, it's also familiarity with investors. So it can be. I mean, I think, if you look, I think it was a year ago, the SEC looked at kind of the naming conventions and some of the funds. Again, I don't know they'll do anything there, but that it is something that they're looking at. And they also looked at, are funds benchmarking to an appropriate rate? I mean, you see some cases where hedge funds are benchmarking to money markets that are clearly equity-based strategies that aren't market neutral. So I think I'm running out of time. And if I didn't get to your question, just shoot it to me individually, and I'll try to return it. So with that, I will wrap it up, and thank you for your time. Hope you enjoy the conference, and hopefully next year we can meet in person. Agata?
Thank you very much, Rick, for all the invaluable insights shared with the audience. And dear delegates, thank you very much for joining us. We hope you enjoyed the session, and please join us on the next one, which is a panel discussion on examining past indexing trend and exploring strategies for the future, which will start at 10:30 Central Time. Thank you very much. Thank you, Rick.
Thank you.